Morning, ladies and gentlemen, and thank you very much for dedicating your precious morning to listening to our webinar. My name is Martin Atidani, and with me is Leanne van Wyk, Spamandla Utelezi, and Mr. J.B. Smith. Okay. I'll start by introducing our speakers. Leanne van Wyk, who happens to be the rose amongst the thorns. She's the only lady amongst a bunch of guys. She will be our first speaker, and Leanne van Wyk, for those that are not aware of her or do not know her, Leanne has provided legal services to the financial services industry for more than 25 years. She's a director of her own legal services company and an editor of an international legal journal. Spamandla, on my far left, has 17 years of experience in the financial services industry and has occupied various senior roles in different companies, including Sanlam, Liberty, as well as Allen Gray, amongst others. And we've got on my far left, J.B. Smith, who's the head of asset execution at NMG and is on his shoulders 16 years of direct investment experience. Okay, so our topics today, our topics today, the first one, which is going to be conducted by Leanne, is going to be on the FSC Conduct 1 of 2022. And Spamandla will take us through the implementation of the FSCA conduct. And the last but not least, to be a talk on the economic updates, which is going to be given by our very learned friend, Mr. J.B. Smith. So, Leanne, the floor is yours. Can you take us through your first topic?
Yes, and thank you so much for having me here today. We're looking at the conduct standard today, and this is all about contributions to retirement funds and how it's changing. So I'm going to give you a brief overview of the conduct standard itself and what's changing, and then Spamandla is going to talk about some of the practical things that NMG has had to do in order to prepare for what is changing. So if we look at the conduct standard, just to know, a conduct standard is law. So it is not a guidance note from the FSCA, et cetera, It is actually sent to Parliament approves it, and then it's published. So a conduct standard is law, and we have to comply with it. It's not optional. Why did we need the changes? So the old regulation to the Pension Funds Act that used to deal with contributions became really outdated, and it needs to be replaced, and this is the way they're replacing it. So at the same time, all the old Regulation 33 stuff about contributions has fallen away and totally replaced by this conduct standard. So because it's already law, we've had to come to grips with that. We did a lot of actions that have had to be taken, both from a point of view of understanding it from a fund point of view, a participating employer point of view, and then, of course, administrators have had a lot to do. So I'm going to leave that to Spamandla to deal with in a later slide. Okay, so if we look at the conduct standard, the first thing that we note is all the different aspects of what it deals with. So the first thing is the notice that goes from funds to participating employers. We're going to look at that. The content of contribution statements, how that's changed. Liability, especially of the employer, attached to providing these contribution statements and contributions. We're going to talk a little bit about how that's changing. And then all the reporting that has to happen when something goes wrong. So, for example, contributions are not paid, or, for example, all the information that you're supposed to get in the contribution statements, you don't receive at all, or you're only receiving a part of it. Then there are prescribed reports from the FSCA. So part of this conduct standard is 3 prescribed reports. So it's a specific format that you have to do them in, and we're going to have a look at that. Then the conduct standard also deals with the penalty interest that is payable when contributions are not paid on time. And then lastly, something completely new that we've never had in the Pension Funds Act previously, it's requirements about if you appoint an attorney as a fund to chase your unpaid contributions, there are certain requirements that you have within place, and that is new. And I know that some funds have had attorneys appointed all along and are now going to have to look at the sort of requirements they need to put in place. Okay, so I'm not going to go through this slide in a lot of detail, just to say it is a complex ecosystem. We've got lots of different moving parts, lots of different players in the contribution space, and they all need to work together to make this conduct standard work and to ensure everyone is compliant with what they have to do. So we're going to talk about some of these players as we go through the slides. The next thing I want to emphasize is this focus on employers. Okay, so we know when the Conduct of Financial Institutions Bill, which is due to be promulgated this year, when that comes into effect, participating employers become supervised entities. Okay, what that means is they don't have to be licensed, like, for example, a fund or administrator, but they will be supervised by the FSCA. That means the FSCA can use all their enforcement powers against participating employers. And we've seen the first step of that in this conduct standard. So they can issue penalties if you don't pay your contributions on time, or if you don't provide the contribution statement information, etc. And they can also do inspections of participating employees, which is not something we've ever seen the FSCA do before. So that's something completely new. So this conduct standard is almost the first step of that preempting that COFI change, which is more focused on the participating employer in relation to contributions. Okay, so in this slide, what you're seeing here is the commentary. So this is comments that have been provided by industry and the FSCA's response to those comments. And in those comments, you see the FSCA very clearly saying, if the employer does not do what it's required to do under the conduct standard or under the Pension Funds Act, then they will take enforcement action. And in this particular comment, you can see them talking about penalties as an example. So very important. Those penalties are over and above the penalty interest that you would normally pay. Okay, so the first thing that that has to happen in terms of this conduct standard is this notification. So there's a notification that goes from every fund to its participating employers. Okay, and that happens in at two times. One, as an employer comes onto the fund, before they come onto the fund, you have to give them this notice. And then every year thereafter, you have to give them that notice again. And it's in a prescribed format. It's something that is set. The format is not something that we would mess with. And Siba Mangi is going to talk a little bit more about that when he speaks. At the same time, that notification goes out from the fund to the employer, upfront and annually. The conduct standard requires that the fund make a request of the employer. This is not new. This is something that's always been allowed for in the Pension Funds Act, or required in terms of the Pension Fund Act. But now it is very clearly set out in the conduct standard that the fund has to ask the employer, who is your person or persons who are responsible, who are legally liable for compliance with 13A. So the payments of contributions and the provision of these schedules, right? And they ask for the person who is personally liable, remember. So at a company and other types of entities, it'll be different, but at a company, it is every director who is regularly involved in the management of the company's financial affairs. So that could be your MD, your CEO, your financial director, you know, whoever it is. Now, importantly, you've got 14 days to give the fund that information. So every fund is then going to have to decide, well, you know, if my administrator tells me now, well, I didn't get that information, what are they going to do about it? You know, so what sort of action will they take? I don't think this is something that you are required to report on. Okay, so if you don't get this information, it's not one of those instances in the conduct standard that requires you to report. The exception to what I've just said is that you will be required to report if you don't have it on your your contribution statement and you haven't provided it before, then there might be some reporting that has to be done. The other thing to remember is that if you as the employer don't give this information to the fund, then every director becomes personally liable for the payment of contributions and provision of statements. And so you are going to be worse, your directors will be worse off if you don't provide this information. So it's important to do it. On contribution statements, so we now have the minimum information that has to be provided by an employer to the fund on a contribution statement. Now, just to note that a fund can ask you for more information because this is minimum information. Okay. That does ease POPIA requirements, Protection of Personal Information Act requirements for each employer, because now they have an obligation in law to provide this information. Okay, so this is a very busy slide, and we're not going to go through the whole thing, but really on the left-hand side of the slide, it tells you what you have to have in your contribution statements. On the right-hand side, it tells you you must add your membership number, plus if the persons who are responsible for contributions at the employer changes, you must add that to your contribution statement as well. Okay, so I want you to have a look at some of these sections. I think we'll do it on the next slide. So some of the sections say where available. So members' cell phone numbers and email addresses where available. My view on this is that if it is available at the employer, then it must be provided. So it's not like, you know, if you want to provide it, you can provide it. It says where available. So if it's available, it needs to be provided. And then perhaps also to note the last bit of that paragraph on your slide, which says that the employer must provide any changes to the data, you know, new members coming off, new pensionable salaries, whatever it is. But then note that last bit, or any other information that may be relevant. Okay, so this requires an employer to give the fund information that will be relevant to contributions going forward. So, for example, if you've got a big retrenchment exercise coming up, then, you know, once you get to a specific stage in that, where it is no longer confidential, you need to start providing that information through to your administrator as an example, or through to the fund as an example of information that could be relevant. Okay, so it's that type of thing that you're going to need to think about. Then the next thing the conduct standard deals with is reporting. Right, so this is the reporting all on one side, and it is fairly logical. I think that there are things that are left out, and we'll talk a little bit about those. But if you look at the logic of the slide, so in the green bubble, that is the person who receives the contributions, who's sitting at the administrator or the insurer, or whatever the case may be. So they're the first person to know, oh my gosh, we didn't receive contributions, or we didn't receive full contributions, or the schedules got half the information missing, or whatever the case may be. So they tell the monitoring person or the principal officer of the fund. The monitoring person is just the person that the fund appointed to monitor contributions. Okay, so they tell the monitoring person or the principal officer. Then the monitoring person or the principal officer tells the whole board. Okay, logical. Once the whole board knows, then the next reports are to the FSCA and affected members. So not all members, but the members affected by whatever the problem is. That could be one member, it could be a participating employer group, it could be all members. Okay. So, and then if the problem continues for a 90-day period, then the board has more communication requirements. And it has to then report to the South African Police Service and affected members again. All right. Now, there are two prescribed reports on the reporting. It's the report to the FSCA and the report to SAPS. Those are your prescribed reports. Okay, so if we look at report 1, and in the conduct standard, you're not going to see report 1, 2, 3. This is just our way of breaking it down. You look at the bubbles on the right-hand side of the slide. This will tell you which report we're talking about. So this is the person who's now noticed at the administrator to ensure that there's a problem. They've got to then report through to the monitoring person or the PO. So I'm not going to go through the time periods with you. They are on the slides and will be available to you after the session. But what they are reporting on is basically 4 things. So problems that haven't been solved from your last report. 2, problems with your contribution statements. 3, problems with receiving contributions themselves. And then 4, if your contribution data and your contribution to the fund don't match up. Okay, so you've got a problem. Now, what the conduct standard says is that if your reconciliation between the data provided by the employer and the contribution, if that problem is less than 2.5% of your contribution that's paid for that month, then you can not report on it. But what I can tell you is, and SEPA Mindly will also deal with this, is that most administrators, I think, will just make a decision to report everything. But SEPA Mindly will talk specifically about that and what energy is doing. Okay, so that's your report 1. So now your PO knows about it. However, what the conduct standard left off by mistake, because FSCA was going to include it, was that the fact that a report must go to the employer as well. So it's not enough to just tell the PO about it. The employer must know about it. You've underpaid, you haven't paid in terms of what you should, or you haven't given us the data. Okay, and SEPA Mindly is going to talk a little bit about the process that NMG follows in relation to that. Okay, so just to note, this is done as part of the process, even though the conduct standard doesn't require it. So the PO now knows, the employer knows. Who's the next body of people who must know? The board. Okay, and it's exactly the same thing that is reported through to them. Okay, and there's a specific time period that it must be reported. Then the next report is report 3 and 4. So now the whole board knows. Now they must tell affected members and the FSCA. But what I want you to note here is that there's a materiality that comes into play here. So the board only has to tell the FSCA and members if it is a material failure or contravention. We're going to talk a little bit about what that means in a later slide. Okay, so here the board is telling the FSCA and telling members. And the prescribed report for the FSCA is something that recently changed. So it was issued, and then the FSCA issued an updated version of that FSCA report. So that's why we've simply included the FSCA report here and not all of them, just so that you know it did change a little bit. These were very practical, useful changes that were made. So, for example, an umbrella fund can now do a report where it attaches a schedule for participating employers instead of doing, reports per participating employer, as an example. It allows for the submission online or a physical submission, and it also allows for ongoing reporting. So remember, when you're reporting to the FSCA, it's not just one report. It's your initial report, and then you have ongoing monthly reporting. So if we look at this particular format, you will see the first thing that you have to do is choose your contribution. So what happened? Are you missing data? Was the data there but wrong? Or is it in relation to contributions that haven't been paid? Then you've got to describe the actions that you're going to take to fix the problem. Okay, so this is part of the report to the FSCA. So this is what we're going to do. And then it requires you to do a monthly upload to the FSCA system in relation to any ongoing issues in relation to your contributions. Right, the last 2 reports. So you've got problems, and now they have gone on for 90 days. At that point, you've then got to do 2 more reports, again to members, and then to the SAPS, so the South African Police Service. Now, the SAPS report is something that the funds have been skeptical about in the past because they didn't believe that SAPS really dealt with it. So what we have seen is that once this affidavit, you can see it's an affidavit on the screen, once this affidavit is actually taken place, SAPS is required to then do something. So they've got to investigate it. So you will see this affidavit has an enormous amount of attachments and information connected with it. Everything from proving that participating employer actually participates in the fund to proving what their contributions were, what your rules require, etc. The FSCA have recently said that they consulted with SAPS on this, that they've done training at SAPS on this, and they are doing a training manual for SAPS. Okay, so they are working with SAPS. And they've said that the expectation is that funds do the reporting at their nearest police station. Okay. Right, materiality. So as I said, certain of these reports have got a materiality requirement. So you're only reporting material contraventions or failures. So what is material? And I can tell you this is really how long is a piece of string. You know, every time I've had to decide something that, you know, is it material or not, it's a very difficult judgment call to make and something you can easily be criticized on. Okay, so it's something that we've got to think about quite carefully. Whose decision is this? It's the board's decision. They decide what is material and what is not material. What I can tell you is looking at things like accounting materiality, a bit of case law, etc., is that a lot more work needs to be done on this. And I think that it would be useful if there was some sort of FCA guidance on it, but there is nothing at the moment. So I think if you're looking at materiality, I think that this is the question you've got to ask yourself. If I was to report this, would that person want to take some sort of action or decision because of what I'm telling them? No, is it meaningful for them? Is there a purpose for me to tell them? Are they going to do something about it? Okay, and that means that even if you don't get information for one member, it may be material for that one member. So you might be reporting to that one. The fact that, for example, contributions could not be invested for them for that month would make it material, right? But the same thing may not be material to report to the FSCA. You know, if you can say to the FSCA, well, we didn't get, if you know as a fund, we didn't get the pensionable salary, but we raised it with the employer, we got it 10 days later. No, that's not really material for the FSCA to know. If that happens every time for 12 months or 3 months, or whatever it is, that may become material over time. But this is very much a case by case, is it material or is it not? Okay, if there's fraud, then I think that immediately makes it material. So for example, if the employer has deducted contributions but not paid them over and the fund becomes aware of that, I think that is material. Okay, so I think that any type of fraud or criminal matter would make it definitely reportable. However, because there is this judgment call to make. If you don't get information on a contribution statement, you've always got to decide, is it material or is it not? Just to mention on interest, so we know penalty interest is payable. It's payable at a specific rate set out in the conduct standard, so prime plus 2%. We've got this whole problem at the moment, which the FSCA raised recently, to say, when do you calculate this penalty interest from? Is it? So say your contribution is payable for February, got to pay by the 7th of March. Do you calculate the interest from the 1st of March or from the 8th of March? Now, the FSCA said at its recent conference, it said the 1st of March, then we received correspondence from them saying it's the 8th of March. So at the moment, we're in the state of limbo where we're waiting for the FSCA to clarify this. They've said they're going to issue an interpretation on it, okay, but there is some uncertainty around that at the moment. Right, this is my last slide, and then I'm going to hand on to Supermantli to do all the practical, useful stuff. Okay, so if you are recovering all your arrear contributions as a fund and you appoint an attorney to do that, just know you have to have an agreement with that attorney. You cannot appoint an attorney who has a connection to your board. Okay, so if you have a board member, for example, that is a partner in a particular law firm, you cannot appoint that law firm. Okay, the FSCA are very clear on that. You need to ensure that if the attorney recovers contributions, that they are paid to the fund within 7 days. There are timelines and there's reporting to do. So if you are appointing attorneys, please ensure you have an agreement. that then complies with all these requirements. Okay, so that's all from me, and thank you very much for having me.
Thank you. Thank you, Leanne. I guess the biggest question is then, what does this mean for NMG as a DNB administrator, right? So I think our journey started when we find out about this conduct standard, and we started getting involved in conversations with the likes of Leanne to make sure that we've got a clear interpretation of what this is and understanding what then needs to be done by us as the administrator. So we have done some communication, which started in June 2022. This was just the communication to the employers and to the funds saying that there's this conduct standard that is coming and this is the information that it will require. So in those communication, we have stipulated the minimum information that we will require in contributions as per your earlier point around the contributions. We've also done another communication early this year in January as a second communication in line with that as well. But just to speak about those communication, I think the most important thing is that we are highlighting the minimum information that is now going to be required when it comes to contributions. And this minimum information that we need, it has a bearing impact, obviously, on how those contributions get to be invested on time. And we will then do the reports around when we don't have those contributions. But there is a whole process that we had to change internally, just making sure that the schedules that we receive now cater for this minimum information that we need to require as prescribed by the provisions. A lot of system work that had to be done, obviously, to make sure that we are aligned. So, because obviously something that was not a prerequisite in the past now is a requirement. So now we need to make sure that we have, and in cases whereby we don't get that as well, we need to make sure that actually we do the proper reporting, especially endpoints around the reports. Other information which has become more important now is around obtaining certain information of certain personnel, monitoring person being one of them. In our instances, we always have the information around who the principal office of the fund is because we deal with them on day to day. But the responsible person who becomes a critical individual now in this process is the information that now we need to obtain and make sure that we keep in our system. By definition, Leanne explained what the responsible person is. It's the person who will be held liable in an event of non-compliance based on Section 13A of Pension Fund Act. So basically, this is the person that will go to jail, pretty much. So. And in an event where we don't have this person appointed, then Leanne explained that the directors of the company will be the one liable for that. So we have catered in our system to make sure that we keep the information when provided to us and we keep it updated. And we've automated our reports as well, just to make sure that they actually reflect the right names of people that needs to be reflected. We will do the reports on annual basis. As I think it's a requirement of the conduct that we do an annual report. So we'll do an annual report that shows who the contact person is and who the contact person is of the fund, and then we also do another report that shows where we don't have we've got missing information. As far as the reports are concerned as well, we have updated our reports to make sure that where there is changes in the information of the members, that is also highlighted on the reports. We will trigger the reports on the 20th of each month. That just shows you where there is a gap. So it will show you that this is your schedule that we receive. This is the information that is missing. And this report will go to the, as per Leanne's explanation earlier on, to go to the responsible person as well as the PO of the fund. But these reports are automated, so each and every person should be getting the report on the 20th of each month when there is a gap in information. Internally as well, we also have covered the staff. So we've updated our training manuals just to make sure that the staff dealing with these funds and the staff dealing with the members are actually aware of what needs to be done. So we updated all the training manuals. We've taken the staff through the training to make sure that they fully understand what the conduct requires and what the provisions of the conduct that we need to cater for as the administrator. Everyone has been taken through that, so that part is covered. Just briefly on the conduct standard, I'm not going to go through all these points, but the Act has 5 critical points that when we were building our processes or updating our processes, we had to take into account. The first one is obviously the notification of the duties and obligation under Section 13A and the conduct standard. So now included in the welcome pack for each new employers, this will be the information that we'll see there, right? And it will be sent, this information will be sent to each employer every quarter. every year, every fourth quarter of every year, we'll send this information to all the employers just to highlight what we have in our system, which will give you an opportunity if you forgot to update your information that we need to have to actually do it at that point. But I think the responsibility still lies with the employer to make sure that actually we've got the most updated information that we need to have. Also, we'll have to maintain the record of the employer's responsible person. As mentioned, I think this becomes one of the most important critical individuals that we will have to have. So upon changes of the person, the employer has a responsibility to let us know that the person has changed and who's the newly appointed person as far as that is concerned. So what NMG has done with regards to this is that the information is now retained in our admin system. So we use one admin system across the board. So everyone going to the system will be able to actually pull the information and say for fund A or for this particular fund, this is the responsible person. It's updated there. And it's also will be in line with what we'll report on. Minimum information is to be contained in the contribution statement. Based on the communications that we've sent, we've highlighted what are those minimum, what is that minimum information that we now need to have. And the reports that will come indicating whether we've got all of that minimum information or not will be based on the minimum information that we prescribed in the communications that we have sent. And that is also being brought into the monthly report that we're going to be doing, the one that I said we will be sending out on the 20th of each month. So it will actually indicate the gap in the information that we have. And then for the reports to the principal officer where the payment and data cannot be reconciled and where the payment of contributions have not been received. So this report will be the similar report to the one that will send to the responsible person pretty much, but it's also it's an automated report which will be made available to the principal officer just to indicate that we have not received the payment. And if we've received the payment, but it's not the full payment, again, it will be the report that will be indicating what has been received and what's the difference between what was received and what was expected. And then the obligation and the responsibility to report to the FSCA, which also is prescribed in the conditions of the conduct. So we've also, all reports will be sent, all contributions of 13A reports uploaded to the FSCA website. That will be done by us upon when the situation requires us to actually do the report to the FSCA. But I think the most important thing is that there has been work that has to be put in place to make sure that this is done. It's smooth, but in my mind, I think this is just, it's going to work if everyone plays the role that they need to play. So we will make the reports available, we'll make the information available. We are committing to making sure that the reports that needs to go at a certain time will go out at a certain time. But the important is also just when we need to be informed of any changes, such as the changes on the responsible person and so forth, then we need to get that information because we depend on that information in order for us to play the role that we need to play as an administrator. Okay, that's it from the NMG in terms of how it's implemented so far. Thank you. I will pass on to JB.
Excellent. Thank you. Thank you so much. Thanks, Martin, for the introduction. It's the first time I've ever been referred to as learned. So as an Afrikaans, it's a big word. Yeah, so we've came from a black and white kind of setting where rules and regulations are set, and nothing in between. And we're moving to a space now where it's pretty much gray all the time. There's no black and white when it comes to the economy, to markets, and definitely when it comes to funds, then we're moving back to the black and white because they set rules and mandates that we follow, that we need to adhere to. So, but I thought it best to start off with just a bit of context of last year. And last year was like being hit at the back of your head. You didn't expect the punches, you couldn't see the punches, but you kept on feeling them. And I want to illustrate this by two charts. So if you focus on the chart on the left-hand side, the scatter chart, it's small, but focus on the large red circle. So it shows you on the left-hand axis, those are US bond returns in dollar terms. If you go higher, that's 45. If you go lower, that's minus 30. On the bottom axis is the US stock returns for the US stock market. And if you go to the far right end, that's positive 60% dollar terms, and the far left is negative 40. These are data sets from 1871. So about 5 years before it's a significant date. So it's really long term. And The one that we know quite well is the financial crisis of 2008. I mean, we all can relate to that. We've experienced that. And 2008 pretty much sits on the upper left-hand side. So that means that US stock markets were down about 30%, but bonds actually came through. Bonds were up 15%. It was a bad year, but it was there was a bit of a cushioning in it. Now the red dot is where we ended last year. I mean, in terms of dollar global markets, we had the worst year since 1871. And I think we tend to forget that. And the reason I think why we actually forgot that, we don't realize it, is that if you look at the chart on the right-hand side, now that's the local equity market. And it's quite a busy chart. So maybe focus only on the blue bars and the red dots. So the blue bars, and that's for 40 years now. The blue bars indicate the return of our local index for that specific year in the rand terms. And the red dot essentially the lowest point in that specific year. So our local market essentially ended, and this is without dividends. So without dividends, you basically ended flat for the year last year. If you add dividends to that, you ended about 3.58% positive. So actually it illustrates the power, the compounding power of dividends. So the local investor, although not the best of year given history and the averages, you're actually a bit sheltered from what happened globally. Unfortunately, most funds do invest offshore. So the energy smart assets do also invest offshore. Not as much as they should be. We're slightly underweight, and in a year like last year, it helped us a lot, given what happened in global financial markets. So maybe a quick 1-minute snapshot of what's currently happening in the markets, and this is data set from until the end of February. It's all rand terms. So our local market ended negatively. Basically, all the markets ended negatively if you look at their base currencies. Now, base currencies for the world index, that's dollar. But if you factor in that our rand depreciated by 5% last month, then essentially it added to offshore markets. And the main reason why we're experiencing a volatile year so far. January, we had this Goldilocks where everything just aligned. We did well. February, reality set in. We're still in an inflation environment, and the Fed is still gonna hike interest rates. Hence we had a pullback in the month of February. So if we focus maybe on the two biggest talking points currently is global growth. We all know we're reliant on growth globally, not only to pick up equity markets or financial markets, but also companies. Companies rely on this growth for them to generate their earnings. So the two talking points is growth and inflation. And what you can clearly see in that left-hand chart, that's the growth for 2022 for a couple of major markets, but also the expectation for this year. And it's kind of like a East versus West scenario where in the West, you've got the UK, Euro, and the US. Basically, 2023 is going to be a flat year for them. The expectation is that we're going to enter a recession. And keep in mind, a recession is essentially the definition is, and this is actually black and white. So it's where you've got 2 consecutive quarters of negative growth. That's a recession. It's not a full year of negative. So we don't expect that for the US market, but we do expect a lot weaker growth globally. Except if you look at the East, you focus on China. China's actually counter-cyclical. The whole global environment. China's expecting a massive pickup in growth, which is actually beneficial for South Africa because China's our biggest exporting market. It's also good for financial markets, Chinese markets, and slightly our market as well. But unfortunately, we've got other problems locally that we need to deal with. So the expectation is we're going to have a pickup in global growth more in the East. Now, if you look at inflation, the right-hand chart, and what you show there is the forecast for inflation for those major markets. So you can see we've already reached the turning point. Yesterday, US inflation came out at 6%. So it's already, if you look at that chart, you look at the US, the gray one, we're already sitting at that between this first and the second dot, right of that line that's running right through. So inflation is trending down. We're still not where we need to be where the targets are. And China, on the other hand, they're still hovering there about 2%. So there's no inflation in China. China instead is they are cutting interest rates. They're stimulating the economy. They're coming out of a COVID recession. Whereas in the US, we're still in this interest rate hiking cycle. Now we're debating how much we're going to hike. Is it still going to be 50 basis points at the next next Fed meeting is going to be 25? So we're still debating it. And then these two primarily drive global financial markets and the economies. But we need not forget the other variables we need to focus on. And it's quite a powerful one chart from the Bank of America Merrill Lynch. They call it their global wave. And it's a composite chart that's made out of 7 variables, which I showed at the top. It's industrial confidence, consumer confidence, capacity utilization, unemployment, producer prices, credit spreads, and also the earnings revisions ratio. So earnings revisions is a company's expecting to make more money as opposed to what they forecasted previously. So it gives a good idea of what's expected. You can see it actually peaked in 2021, 22, and it started to come down now. And it's significant. And it's significant for this reason. So what's overlaid here is actually the performance, the year-on-year performance of world equity, the MSCI World Index. You can actually, it do follow that, not to the T, but it do follow this global wave. And we're at the point now where some of those variables are starting to turn. Some of them are still essentially a bit on the stronger side, which can actually push that chart lower. But we're essentially at an inflection point in terms of what we expect in markets. If you focus on the US market for a moment, and the one thing that we've heard repeatedly, and hopefully that everybody's heard, is the phrase, the inverted yield curve. It's something that's been echoed all over, and that's what the chart at the bottom essentially is showing. So the inverted yield curve, basically it's your 10-year yield, US yield minus your 2-year yield. So what that implies, the 10-year yield signifies what the economy is expecting, and the 2-year yield is what the Fed is signaling. So the Fed is signaling interest rate hikes. If you look at the chart, we are basically, for the last 4 decades, at the lowest point ever. And each time that thing goes negative, we are in a recession type of territory. Now, it's not a set in stone. It just indicates the probability of the global economy, the US economy, especially going to a recession, is quite high. It's also not a timing indicator where it's going to happen now. It's somewhere in the future we're going to expect a recession in the US. We sort of don't know what the magnitude of that recession is. And the reason why we focus on the US, that's a top right-hand chart, is that the US is still 60% of the global financial markets. So the barometer of world indices, the MSCI World Index, 60% of the index is the US. So we always joke and say in South Africa, if the US sneezes, we catch a cold. Pretty much the world also follows that logic, where if the US market turns sour, it's going to flow through into world financial markets. Hence, it's important to focus on the US. But then there's another phenomena where we not only focus on recessions, but you also need to focus on earnings recessions. And that's where companies start to make much less profit. And that's the chart that just came onto the screen. So you can see the gray areas are the recessions, and it actually corresponds to that inverted yield curve. You can see each time there's a recession, company earnings fall. They fall by quite a lot. And so we've seen that now. You look at the end part of the chart, earnings are falling, but the expectation is that earnings are still going to keep on falling. So we haven't reached that turning point yet in specifically US companies where you feel like we've reached the bottom of those earnings. So it's something that you need to be wary about, is what's going to happen with US earnings. And I did mention China and the Chinese economy being counter-cyclical to the world economy. So on the far right, the blue line is basically the Chinese business cycle. So you can see that actually it actually peaked, or actually it bottomed out and starting to tick up. And it actually correlates with the earnings in emerging markets. And if you look at Chinese companies, again, on the far right-hand side in that chart that says China return on equity, the red line is basically the average. And we're sitting about 1 standard deviation below the average. So Chinese companies are coming with a low bottom. So in a low bottom, in an economy where you are stimulating, you're cutting interest rates, and even more where there is so much pent-up demand. And the pent-up demand is illustrated by the chart right slam bang in the middle. That is the Chinese household deposits. You can see how that increased and at what level they're currently sitting. And the loans, how the loan levels have decreased. So the Chinese consumer has got a massive amount of cash that's sitting idly. Now, take that, combine that with companies that's at the bottom of the earnings cycle, cutting interest rate. That's why we believe that China is still in a quite a turning phase, and why any emerging market exposure in a portfolio and a measured amount, not a lot, is quite good diversification in any portfolio. And if we turn to SA, and here we can spend a lot of time. I mean, if you look at our economy, our mining production has been down for so many quarters now. It's hard to keep track. The one saving grace for our mining sector is that your revenue is linked to the dollar. The dollar strengthened tremendously. So, and that's why the FSCA, not only this financial year, but the previous one, can actually generate more revenue. And that's why, if you look at this past budget, there were no significant tax increases on the consumer, because we've got quite a massive revenue overall from commodity prices. But we are sitting with Eskom. We've already seen that filtered through, where growth expectations have come down from 1.3% to about just positive. So it's a massive effect on our economy. We're entering an election year, next year's election. We know it's an election year process, so no politician is going to do something meaningful until after the election. We did also hear that from the president, where in the cabinet reshuffle, he explicitly said that next year is going to be changed in regime, or not changed regime, but it's going to be his next term in office. So they're not making any significant changes now. But there are some positives that we need to highlight in terms of what is being happening. And being investments, I thought it fitting to mention this one. So we had this state of capture commission. We spent R1 billion on that commission. We all moan about that. But do we realize that commission actually brought in so far 12.9 billion of money that was recklessly spent on corruption? So from an investment point of view, so if we had a fund, that fund had R1 billion worth of capital, our return would have been 11.9 billion. Massive. So there is some good that came out of that. But in any economy, and specifically in our economy, the release valve for pressure is our rand and our bond yields. And if you look at this chart, it shows how the rand dollar has performed since, it's got 23 years. So the dark line is basically the par value of or the fair value of our currency on the purchasing power parity with about a band. But what you can see essentially is our currency fluctuates in and out of that. But at some point in time, when it overshoots, it does come back. And if you look at the current scenario, our rand just bombed out completely. Now, the misperception is that it's all due to all the shenanigans locally. About 2 weeks ago, we had the grey listing. And clients saying, look, grey listing, the rand bombed out. But essentially, the majority of our movement in our currency is the dollar. It's not, yes, our local factors influence it, and it will add to that. But the major factor is the dollar. The dollar is being on a strengthening tear for the past year and a half. And that essentially led to our rand just bombing out. And at some point in time, that needs to return. And that's where when you're investing offshore, you need to make extremely certain of where you're investing and make sure that you're counting for, at some point in the future, you're going to see this dollar reversal. And that's what happened in January. That's why our markets was up 6-7% in January. Emerging markets were up. It's because the dollar actually reversed course. So we need to be aware of that. And if you look at our market and the next chart, it actually shows the P multiple. Now, the P multiple essentially is the indicator of whether the market is cheap or expensive relative to its own history. And what I show is the one let's focus on the green and the black one. Those are our local market, and the other two ones is the S&P 500 and the All Share World Index. So on a cheapness valuation basis, we are essentially providing more value locally than globally. So now you're sitting with a case of where our stock market is relatively cheap and globally but expensive or fairly valued, with a rand that's overshot completely. So it's wise to have a bit of assets invested locally, and that's why we still invested locally in local equities, and have got a significant amount of assets invested locally. Just keep in mind that what happens on the political front, the economic front, doesn't normally translate into our financial markets. Why? Our biggest export partner is China. A majority of our large entities, companies, earn their revenue outside of our country. So we are an open economy. So never confuse our political scenario and our economic scenario with financial markets. yes, the one influences the other, but you need to understand to what magnitude. So, given all of this, what's important in terms of when you look at your investments? And I've got two fascinating charts that I want to share. So the first one is that pie chart. Is that when it comes to investing, 57% of your return is based on just your pure decision to invest. Investing and staying invested. That's almost two-thirds of your return. Then 27% is by choosing the correct managers. So that's where we come in and we choose the correct managers, follow a process, and we find the most suitable managers. That's 27%. And the last 16% is making a bit of changes, being a little bit overweight equities, underweight bonds, those type of nimble changes. But the majority is just stay invested. And that's difficult. It's really difficult. And if you look at the right-hand side, that's illustrate why it's difficult. It's data from JP Morgan, and only focus on the light blue and that orange chart. So the light blue is the typical 60-40 portfolio. 60% equities, 40% bonds. Over the last 10 years, yielded 11.1%. Easy enough. Stay invested. But the orange one is the average investor, 8.7%. The difference between those two is the fact that you just cannot follow that stay invested mentality. It's your own biases that influence you to make changes. So it's important. That's a fundamental thing about investing. It's just stay invested. And then, so we've all heard that phrase of past performance is not an indication of future performances. It's a nice disclaimer that we need to put on any marketing material. And given all the legal stuff we've heard, we usually make it quite as small as possible. As small as compliance will let you do, because it takes up a lot of space in any reporting pack. But there's so much truth in that. And I want to illustrate this. So what I did here is I said, look, let's just invest in past winners. It's easy investment strategy. Why not? Let's do it. So this is what we did. So we had a look. So if you look at 1 January 2011, we did an exercise where at the end of 2010, we had a look at who's the best manager. And these are typical stable managers. So these are the likes of the NMG, Smart Active and Smart Passive Conservative. So it's those type of portfolios. But we did this on the whole universe of South Africa. Those types of portfolios. So each year we had a look at who's the best manager, and the subsequent year we invested in that manager because he was the best last year. And that's the red line. The green line essentially is the average of all the retail funds available in the same category. The average, midpoint. So by investing in past winners is an investment strategy, you actually underperform the average guy in the market. And just by sheer measure, because you're working with pension fund assets, you need to do a bit of financial planning, that's typically CPI plus 2 is your barometer. You actually underperform that barometer. So the implication is when you retire, you would retire with less than what you thought, what your projections would have indicated. So picking past winners and only running for winners is not going to help you at all. That's not an investment philosophy. So why do you need an investment process? Why do you need to follow it rigorously? And I put on that crystal ball because for some reason people think we've got crystal balls and we can foresee the future. Believe me, if we did, I would manage my own money, nobody else's, because I would make a lot of money. So, and I want to illustrate that there's no crystal ball. So what you've got is the chart of the JSE, normal. And then we said, look, in this 10 years, for each calendar year, let's just remove the worst month. Let's say you can set out the worst month for each year. And this is what would have happened. Yes, you would have done extremely well. But let's say that you set out the best year, the best month, not your best month, and that in each calendar year for the past 10 years. So you've done quite poorly, half what you should have done. And then just for completeness sake, let's remove both. You see same result as the all share, but just less volatility. And then cash, because everybody thinks you can get the best in the bank. So what this indicates is that even if you missed the best calendar month in the past 10 years, you would have done better than just sitting with cash in the bank. But this is not the message. The message is that have a look at how close that worst and best months are to one another each calendar year. So they're quite tied together. There's no way that you as an investor can time any market and think you're going to climb out before it falls and climb back in before it rises. And unfortunately, out of bitter experience that I've seen analyzing investments and books is that most clients enter at the bottom, or exit at the bottom, and they enter at the top. So that's not a strategy. Then second from last, just what do we expect in terms of expectations? Taken from two of our managers that we've appointed. Don't focus on the amount, just on the trend. These are long-term forecasts, 10 years plus. So next 10 years, we are, given where we are now, we set to generate some decent returns. And the nice thing is to see our local market essentially is at this point in time providing better return opportunities than the global markets. And I'm showing two different managers just to not to be biased and not to only focus on what the message I want to get across. So, but the point is, we're going to have years where it's bad and years where it's excellent, but you need to stay invested. So thank you so much. I'm going to end up with a story. It's given where we are now. And it says that, I'm going to read it off. It says that an oil prospector moving to his heavily rewards was met by St. Peter with bad news. You're qualified for residence at St. Peter. But as you can see, the compound reserved for oil men is packed. There's no way to squeeze you in. After thinking for a moment, the prospector asked if he might say just 4 words to the present occupants. That seemed harmless to St. Peter. So the prospector cupped his hand and yelled, all discovered in hell. Immediately the gates of the compound opened and all the oil men marched out to head for the northern regions. Impressed, St. Peter invited the prospector to move in and make himself comfortable. The prospector paused. No, he said, I think I'll go along with the rest of the boys. There might be some truth to the rumor after all. So I think the message is that we're bombarded by news flow. We're sitting with a political environment which is unstable, locally and globally. We've got the second largest US bank failure since 2001 last week. So a lot happened. Just don't be influenced by news flow. Don't let it influence your investment decision making, because you're going to have a massive detrimental effect on your end result. So that's all from our side. I want to thank everybody, and I wish I had time for questions.
Thanks. Thank you very much, JP. Thank you very much to all the speakers. Ladies and gentlemen, unfortunately, we've run out of time. I'm sure a whole lot of us have a bunch of questions that we wish we could actually throw to the panel, but unfortunately, because of time, what I would recommend is you can just type in your questions, send them through to us, and like the previous time, you will be getting answers to those particular questions. Thank you very much, all the speakers. Thank you very much to all the guys for tuning in, and hope you have a wonderful day. Thank you.
Thank you.